Good evening, everyone. Welcome to Phillip Futures webinar. Thank you for your time by joining this wonderful webinar. My name is Yongxuan from Phillip Futures Marketing, and I'll be the MC for today. So during this webinar, if you have any question, do type them into the question box, and I will address the questions during the Q&A session. So at the end of the webinar, before we introduce our speaker, please allow me to introduce our company. So as usual, I will need to emphasize on our disclaimer where this presentation has not been viewed by the Securities Commission Malaysia, and it is provided to you solely for general information, and it does not constitute any recommendation. We are not liable for any losses arising and based on this information. Investments are subject to investment rates. Therefore, you shall seek advice from qualified advisor before making any investment decision. Okay. Phillip Futures is a wholly owned subsidiary of Phillip Capital Holdings Sdn Bhd, and it is incorporated on 7 October 1995. So our headquarters is in KL, and we have branches distributed across Malaysia, such as Kota Damansara, Melaka, Penang, Johor, Kuching, and also KK branch. So other than that, Phillip Futures is a trading participant of Bursa Malaysia Derivatives Bhd, a clearing participant of Bursa Malaysia Derivatives Clearing Bhd, and also a holder of Capital Market Services License, which is known as CMSL. So I would like to take this opportunity to extend our gratitude on behalf of my company, Phillip Futures, to our clients. So without you, we are unable to achieve the awards, and in 2020, we achieved 3 awards from Bursa Malaysia. We won the best overall, the derivatives, the best retail derivatives, and the best institutional derivatives trading participant. So for our mother company, Phillip Capital, we have offices and branches over 14 different countries. So for the Asia side, you can see we have Thailand, Malaysia, Singapore, and to the European side, we have the United States, United Kingdom, and France. Okay. For futures, we do not only cover products in Malaysia, we also covered from different exchanges such as Singapore Exchange, CME, CBOT, NYMEX, CBOE, and more. So with our strength of global coverage, clients are able to trade both local and foreign products under the same platform. These are the products available in Phillip Futures. On the left side, we have futures, which index futures, metal futures, agricultural, energy, and interest rate futures. And for the contracts for difference, we have Bursa Malaysia, NYSE, and Nasdaq. So why should you choose Phillip? First of all, we provide advisory service such as enquiries. Next, we provide a wide array of products for futures that enable clients to trade both local and foreign products. Other than that, we send out latest market news and commentaries to clients every day through email for references. Lastly, our headquarters have 24 hours booking and execution support. This is very important for clients who trade foreign futures and also dealers who can assist to your inquiries anytime. So no matter you are our client or not, we do offer free one-to-one coaching session, free seminars and webinars, and also free account opening. Okay, so for free one-to-one coaching session, the key topics that we usually will be focused are introduction to futures trading, the product knowledge, platform coaching, and also charting system. For now, we conduct free seminars and webinars regularly, but since we are unable to organize physical seminars at the moment, we will focus to provide more live webinars with different topics for you to join. So for the upcoming live session, we have this Facebook Live on 22nd of September, which is on Jom Listen What Do Traders Do from AM to PM. The time is 7:30 PM to 8:30 PM. So if you have, so you can scan our QR code here to join our page for the live session. And you also can follow our Phillip Futures Sdn Bhd Facebook. Okay. So for now, I would like to introduce to you our speaker. Her name is Shireen, and let's enjoy the session for today.
Okay, so good evening, everyone. This is Sherin here. I'm the marketing executive and dealer with Phillip Futures. And in today's webinars, we will be sharing a few basics on the futures market with a few examples and what are the factors that drive the futures market. So before we begin, I would like to do a sound checks. So if you can hear me loud and clear, just type yes into the question box. Also, during the webinars, if you have any questions, to type them into the question box and I will address the question during the Q&A session at the end of the webinars. So without further ado, let's start today's webinars. Okay, so what is futures trading and how it works? So futures are legally binding contracts which make on the trading floor of the derivative exchange or where dealing system which refer to you can direct access to the market by electronic device to buy or sell asset, as an example, commodities or financial instruments in futures. Futures contract is an agreement to buy or sell and agree upon the quantity of an underlying asset at the specified date and for a settled price. Besides, futures contracts are standardized agreement that typically trade on the exchange. Now, before entering into the futures market, which known as taking positions, an investor should be aware of the four main elements of the futures contract. These instruments are much different from buying shares in company in stock exchange. So what are the futures products that are available in our Phillip Futures? So there are 5 types of futures contract. First one is the agriculture futures, such as we have crude palm oil, we have wheat, corn, or coffee. Second one, we will move to the index futures, such as our Malaysia FKLI, Hong Kong Hang Seng Index, US Dow Jones, or China A50 Index. Next will be metal futures, such as gold, silver, and copper. Lastly will be energy futures, such as crude oil, natural gas, or gasoline. Okay. For this slide, I will explain about the 4 elements in the futures contracts. So which are the 4 elements? So first one, that is the asset class. Asset class is which the contract will specify the asset that underlies the contract, which is critical in measuring the value of the trades. Some of the mostly high traded assets in futures trading include energy products, agricultural commodities, precious metal, equity indices, and forex. The second one will be referred to the quantity, as the quantity explains the size of the contracts, which typically outline the specific number of the units being bought or sold. For example, one contract is WTI crude oil futures give the holder the right to acquire 1,000 barrels of oil. Next is the expiration of futures contracts. Futures contract must have an end date, which refers to an expiration on the set date in the futures. The expiry date is the final date the contract can be traded. After the date, the contract must be settled under the terms of agreement. Lastly is price. The price of the contract is ultimately determined by the open market, reflecting the value of the asset involved. A future contract, however, will contain a specific price, usually tied to the spot or cash price of the underlying commodities. The contract will also make clear what currency is being used in the contract, such as whether the price is priced in MYR or other denominations. Okay. In this slide, I will explain about the settlement. As in futures contract, we have 2 types of settlement, which is physical settlement and cash settlement futures. Cash settlement is referred to a cash payment is made based on the underlying reference rates, such as the closing value of the stock market index. The parties settle by paying, receiving in the losses or gain related to the contract in cash when the contract is expired. Cash settled futures are those that for practical matters could not be settled by delivery of the reference items. For example, it would be impossible to deliver in an index. A futures contract might also optimize to settle against an index based on trade in the related spot market. The KLCI index are used this type of settlements. Physical delivery is referring to the amount specified of the underlying asset of the contract is delivered by the seller of the contract to the exchange, and by the exchange to the buyer of the contracts. Physical delivery is common with commodities and bond. So in practice, it occurred only on a minority of contracts. Most are cancelled out by purchasing a covering position, that is buying a contract to cancel out an earlier sales, which is we need to covering the short position, or selling a contract to liquidate it in an earlier purchase, which is covering a long positions. So the crude palm oil futures, which is our FCPO contract, are using this method of settlement upon the expiry date. Okay, so in this slide, I will do a simple introduction of Malaysia crude palm oil futures, which is a FCPO contract specs. As you can see, the contract size of FCPO is 25 metric tons. As the contract value is 4,000, so you need to times by RM25, which is the actual value for FCPO is equals to 100,000 ringgit. While for the minimum price fluctuation is RM1 ringgit per metric tons. So today I give you a simple example. So if today you enter the market with the long positions, which is the price at 4,000. So when the price is go up to 4,001, hence you already earn 1 point, which is RM25 ringgit. So the final settlement for FCPO will be physical delivery settlement based on the final settlement value. While the final trading date for FCPO will be on noon time on the 15th of the day of the delivery month. So if the 15th is not market day, they will be presenting the business day. For FCPO, there's a 2 trading hour, which is we have first trading session, which is 10:30 a.m. to 12:30 p.m. and the second trading session is from 2:30 p.m. to 6 p.m. Lastly, for your information, one contract FCPO, the initial margin that required is 6,000. Okay, so why do people trade futures? There are 4 types of benefit in trading futures, which is we have leverage, high liquidity, bidirectional tradings, and low transaction costs. So first, futures is high leverage investment, as leverage means that the trader need only commit a little money to control a lot of products. Since futures contract is based on deferred delivery, no money is exchanged at the time a trader buy or sell the futures contract. Therefore, not a lot of money is needed to buy or sell a futures contracts. The margin that traders have to deposit when they buy or sell a futures contract represent the performance bonds, which is the guarantee that they can handle the risk of these futures positions. So as you can see, this is the example of leverage. Let's give you an example. So in futures market, normally we only need 5 to 20% of the full contract value to enter the positions, which means that a small movement in the market could translate into big movement in your portfolio. So we use FCPO, the crude palm oil, as an example. So the current market price for FCPO is 4,000, while 1 point of FCPO is equals to RM25 ringgit. So the contract value for FCPO is equals to 4,000, which is the current market offer price, times the 35 ringgit, which is equal to 100,000. This is the true value of FCPO contracts. Well, in the futures market, you just need 6,000 as the initial margin to enter into the futures market. So this is, as you guys can see the slide, is regarding all the profit side. So we assume that today we bought one FCPO contract with the price of 4,000 and market go up to 4,030. Hence we sell off our positions and we get 30 points, which is 750 ringgit is our profits. So let's see the comparisons. So if you enter the trade at the cash market with the contract value of 100,000 and our profit is 750 ringgit, hence our return on investment, which our ROI, is only 0.75%. So how about if you enter the trade in futures markets? As you can see, one FCPO initial margin is 6,000. Hence with the profit of 750 ringgit, our return on investment is 12.5%, which is more higher if compared with the cash markets. So how about with the losses side? So Assume that today we buy one FCPO contracts with a price of 4,000 and the market is against your position, which is closed at 3,980. Hence, we already lost 20 points, which is 500 is your losses. So you can see again the comparisons. So if you enter the trade at cash market with the contract value of 100,000, compared with our losses is 500 ringgit. Hence, our return on investment is only negative 0.5%. So how about in futures markets? So in futures market, with the initial margin of 6,000 FCPO contracts, with the losses of 500, our return on investment is negative at 8.33%, which is more higher compared with the cash market. So as you can see, using leverage to trade the products, your profit side can be bigger, and then also same goes to your losses side. Okay. Next is the market liquidity. Market liquidity is important for a number of reasons, but primarily because it impacts how quickly you can open and close the positions. A liquid market is generally associated with less risk, as there is usually always someone willing to take the other side of a given position. This can attract speculators and investors to the market, which add to the favorable market conditions. High liquidity means that there are a large number of orders to buy and sell in the underlying market. This increases the probability that the highest price any buyer is prepared to pay and the lowest price any seller is happy to accept, which move close together. In other words, the bid and offer spread will be tightened. So this is an example on showing how to see which might have the highest liquidity by using our platform, which is Phillip Nova. For FCPO, you can see currently the volume for November 21 is 16,794, which is the highest compared with other months. So you can define which is the active month through the volume. And then it also same goes to the FKLI. As you can see below the chart, the FKLI September 21 contract, the volume is 3,463, which is the highest volume compared with other contract months. But you also can do the bidirectional trading in futures markets. So let's give you examples. If you assume today market will go uptrends, hence you can go long to the market with buy positions. In another way, if you assume today market will go downtrend, you can also short the market with short positions, which means actually you are exposed to two sides, which have more opportunity to earn your profits. Lastly is low transaction cost to trade in futures market. As you can see from the table below, in futures market, per entry fee is RM11, which means that both sides complete one transaction in and out, it only will charge you 22 ringgit. While in cash market, as you can see, they will charge you the progress fee, stamp duty fees, and clearing fees, which make your transaction cost become more heavier compared with the futures markets. Okay. Next is the market player in futures markets. So there is in futures market for commodities or financial products, because they are the people which conduct an active business in that commodities. So hedger are referring to the risk averse in the stock market or futures. They target derivative markets to secure their investment portfolio against the market risk and the price movement. So I give you an example. There is a corn futures contract because they are corn producer who sell corns and the company that buy corns. The hedger plan to buy a commodities such as a corn and buy the futures contract to lock in the price and protect against the rising or falling the price. The need for risk management that futures can meet holds true for all markets, including financial market. So internationally, companies hedge their foreign exchange and interest rate exposure. Similar, portfolio manager hedge the stock fund risk. Normally, hedger will be referring to those producer, wholesaler, and retailer or manufacturer. Second market participant is speculators. Speculators are people who analyze and forecast futures price movement, trading contracts with the hope of making a profit. Speculators put their money at the risk and must be prepared to accept outright losses in the futures market. So How do the speculator get their profits? So speculator can earn a profit when they offset futures contract to their benefits. To do this, a speculator buy contracts, then sell them back at the higher contract price that at beginning at that purchase at them. So conversely, they sell contracts and buy them back at the lower contract price than they sold them. So in another case, if successful, a profit is made. In other words, speculator can refer to traders, and speculators are important in the futures market as they are bring liquidity and assume the market risk. Lastly is arbitrage. Arbitrage are risk-free arbitrage technique which return a profit without any directional risk. Which means that if the arbitrage technique is applied properly, you will make a profit no matter which way the underlying asset moves. Arbitrage have existed for as long as the capital market has and futures. So arbitrage is a way of making advantage of the price difference between the underlying assets and the price of their futures contracts. So in the facts, every derivative instruments created on the same underlying assets get slightly mispriced from time to time, and arbitrageurs have sophisticated programs to detect and take advantage of such minor difference in the price. For this part, I will brief about what is margin call and how come you trigger margin call. Normally, margin call will open when the trade will happen when the trader do not have enough account balance to hold their overnight positions. So assume that today you buy one FCPO contracts at the price of 4,000 with the long positions. The required initial margin for FCPO is 6,000. So when the market is closed at 3,960, which losses 40 points, so 1 point is equal to 25 ringgit. So your losses will be 1,000 ringgit and your cash balance only left 5,000, but you still hold your position overnight. Hence, in the next day, you will receive a 1,000 margin call from broker house as your current equity is less than the maintenance margin of 6,000. So this is how the margin call will be triggered. Okay, so next I will brief the introductions to FKLI, FM70 and FCPO and what is the key fundamentals that drive the futures markets. First is the FKLI contract specs. The underlying asset for FKLI is STSC Bursa Malaysia Kuala Lumpur Composite Index. The contract size for FKLI is multiplied by RM50 ringgit, while for the minimum price fluctuation is 0.5 index point, which is valued at 25 ringgit. So make it easier, 1 point is equal to 50 ringgit. The final settlement for FKLI will be cash settlement based on final settlement value. For FKLI, they have 2 trading hours, which is the first trading session is 8:45 AM to 12:45 PM, and the second trading session is from 2:30 PM to 15 PM. Well, the final trading day for FKLI is last business day of the contract month. So as an example, if the last day of 31 of the end of the month is dropped on Saturday, so the last business day will be on the previous day, which is on 30 of the month, which is Friday. So lastly, for your information, one contract for FKLI, the initial margin is 4,200. Okay, as you guys can see from the graph, this is the latest list of 30 component stock company which is listed in the FKLI. As you can see from the tables, we have 20 types of super sectors which include in the FKLI index, while the top 3 largest weightage will be bank sector, healthcare sector, and food and beverage. However, this is quite important as there is any factors on these 3 biggest super sectors. It also will directly affect the performance of FKLI index. So as you guys can see, this is the 30 company which included in the FKLI index. Okay, in these slides, I will explain about what is FM70 and why should we trade FM70. FM70 is a Ringgit Malaysia's MRL dominated mini FTSE Bursa Malaysia mid-30 index futures traded on Bursa Malaysia derivative. Besides that, with FM70, the trader can gain exposure to all the 70 constitutions of FPM mid-70 with a single futures contract. So this is the FM70 contract specifications. The underlying asset for FM70 if FTSE Bursa Malaysia mid-70 index. The contract size is for FM70 is multiple by RM4, where the minimum price fluctuations is 5 index points, which is valued at RM20 ringgit. The final settlement for FM70 will be cash settlement based on final settlement value. For FM70, we have 2 trading hours, which is the first trading section is from 8:40 AM to 12:45 PM. And the second trading session is 2:30 PM to 15 PM. While the final trading day for FM70 is last business day of the contract month. As an example, if last day, which is 31, is dropped on Saturday, so the last business day will on the previous day, which is on 30 Friday. Actually, same with the FKLI. So for your informations, one contract of FM70, the initial margin is 2,500. Okay, this is the letter list of 70 component stock company which listed in the FM70. As we can see from the table, we have 15 types of super sectors which include FM70 index, while the top 3 largest weightage will be consumer industry, technology, and telecommunications and media. However, this is quite important. So if there is any factors on these 3 biggest super sectors, it also will directly affect the performance of FM70 index. Okay. So based on the graph above, this is the top 10 constitutions which include in the FM70 index. Next, I will move about the factors which will affect the FPM, FKLI, and FM70 market sentiments. So first is interest rate. It was indicated that interest rate stay consistently low, which in turn was a boom for economic growth and equity market. This could be seen from the US Federal Reserve low rate and recorded breaking performance on Wall Street. In other words, money always seeks for better yields. The low interest rate also brought down borrowing costs, which is a blessing for the corporate world and consumers. The business communities could borrow at low rates for expansions, helping to sustain the earning growth, while consumers could spend more as loans are cheaper. Second is crude oil. As the oil revenue is a large contribution to the government coffers, strong crude oil price would mean fewer coffers for the governments, which would have more to spend while being able to rein in the fiscal deficit. The opposite would happen if the oil price were fall. The price movement of 2 types of oil, which is crude oil and crude palm oil, have a significant impact on the local market, given that oil and gas and plantation are 2 major sectors on the local. When they are out of favor, Bursa Malaysia will have less appealing to the investor, especially to those foreign investors. So in the meanwhile, the COVID-19 infections has not only become a public health crisis, but has also affected the global economy. Significant economic impacts has already occurred across the globe due to reduced productivity, loss of life, business closure, trade disruptions, and disseminations of tourism industry. COVID-19 may be that a wake-up call for all the global leaders to intensive cooperation on the e-pandemics preparedness and provide the necessary financing for international collective actions. There has been ample information on the expected economic and health cost of the infectious disease outbreak, but the world has failed to sufficiently invest in the preventive and preparedness measure to mitigate the risk of the large pandemics. Fourth is the political reasons. The politicians are responsible for policy decisions and forming regulation governing the nation, which is directly and indirectly affect the company, local market, import and exports, purchasing the power, and economy as well. Uncertainty. Trader dislike uncertainty like price drop. Malaysia's equity market was expected to stay volatile due to short-term policy uncertainty following the unexpected changes in country political uncertainty and external challenge. As one of the main factors that have kept investors on the slide of the local stock market is uncertainty over the planned handover of power between the Prime Minister. So speculations on the transaction aside, investors are more prefer to wait for the dust to settle on the political front and for to be a certainty on policy before investing in the country. Lastly is trade war, which is referring to the US and China trade war, which also will bring impact on the performance of FKLI index. So this part is about crude palm oil, which is our FCPO. So I will brief you guys again regarding on this FCPO contract specs. So the contract size of FCPO is 25 metric tons. So well, for the minimum price fluctuation is RM1 per metric ton. So the final settlement for FCPO will be physical delivery settlement based on the final settlement value. Well, the final trading day for FCPO will be on the noon time of the 15th of the delivery month. Or if the 15th is not market day, then will be preceding business day. So for FCPO, actually we have 2 trading hours, which is from 10:30 a.m. to 12:30 p.m. And the second trading session is from 2:30 p.m. to 6 p.m. Okay, lastly, what is the fundamental factor that will affect the FCPO tradings? So first is the weather seasons. The plantation of palm oil tree follow their specific season and periods. The whole process from planting to harvesting will take up to 4 years, and the lifespan of the tree can be up to 25 years. Palm oil tree require warm weather with high humidity environment to grow up healthily, as too much of rainfall could flood the plantations and hamper the harvesting, and dry spell would affect the plants grow, thus slowing the plant productions. So I give you an example. The El Nino affected influenced Malaysia palm oil yield in 2016. The production had been dropped to 3.15 tons per H, which is the lowest of this day. So actually, the average is 3.7 and above. Hence, flood season can affect the yield of palm oil, which lower the productions, translate to a higher the palm oil price in the markets. Second will be the festival season, as it can increase the demand for the oil. So give an example, Chinese will buy palm oil for their Lunar New Year holidays, while India will buy the palm oil for their Deepavali, while for Pakistan, Bangladesh, and Middle East country will buy for the palm oil for their Eid festivals. So people will use it for the regional praying purpose. With the high demand for oil use, the price of crude palm oil will be increasing too. Thirdly will be our biggest competitors, which is Indonesia. The production of palm oil in Malaysia and Indonesia has taken up around 90% of the supply of the world. Malaysia is currently the second largest palm oil exporter in the world, who is surpassing by Indonesia in 2006. Indonesia are expected to double their production by the end of 2030. When Indonesia keep increasing the output, it can cause the price decrease, and the profit margin of Malaysia can be affected. Or there might be another situation if Indonesia can supply most of the demand in the market with a better tariff rate, Malaysia will lose our competitors' ability or being forced to sell at a lower price. Fourth will be the competitors for other edible oils, as the price of palm oil can be affected by other vegetable oils like sunflower oil, rapeseed oil, corn oil, and especially soybean oil. When the bad weather falls on the soybean plantations, it can help in increasing the palm oil price. So for US, Brazil, and Argentina are soybean producer countries. Once their oil supply is below the market needs, palm oil will be the substitutions. Lastly will be the tariff and policies. Malaysia relies on exporting to build up the country economy. Hence, to hit the GDP higher, the government may lower down the tax rate to help in strengthening the export and reduce the inventory level. This action can make liquidity if the market is higher, which is more favorable to traders. Okay, that's all presentation for the how to trade futures in an introduction in futures trading. If you guys have any question, you can drop it at you can put it at the answer box, in the question box, and then I will answer it accordingly. Thank you.
Okay, so you guys can, so if you have any questions, we'll address it later. So before that, hold on. Okay. Okay, so for Phillip Futures, we have successfully launched the first futures trading online account opening in Malaysia, and you can now open account futures trading account online with no hassle. So if you wish to open futures trading account online, feel free to visit our website, or you can just directly scan the QR code and it will direct link you to the online account opening form. So if you need any guidance on online account opening, please do not hesitate to contact us. So for free account opening, you will receive complimentary mobile and desktop platforms at no cost. And besides that, for the desktop version, it's a web-based platform, and for the mobile version, you can trade using the Phillip Nova application, which allows you to trade anywhere and anytime. Okay, so currently we are doing a few promotions. So for the first one, of course, if you open account first, you can receive cash rewards and Foodpanda vouchers with us. And next we have Phillip Star Trader, where we will be doing lucky draw prizes worth up to 50,000. And lastly, for To the Moon with CME Micro Mini, where this is on the US indices and the foreign products. Do contact us if you have any further questions, and you can also connect with us now. You can look for us through Phillip Futures Sdn Bhd. We have Facebook, LinkedIn, YouTube, and for Instagram, you can search for Phillip Futures Malaysia, and also Telegram, you can look for Phillip Futures. So if you have any question, you can just contact the Malacca branch. We have our contact number, or you also can directly email to us. So now will be the Q&A session. Hold on. Okay. So I think there's one question by Aurora. I think this is the part where it is quite slightly fast. Sherry, maybe you can share your screen and go back to the FM70 site. Yeah.
Okay, okay, so I will show you the 10 components which included in the FM70. So as you can see, this is the top 10 constitutions which included in the FM70. As you can see, actually we include British American Tobacco, the Carlsberg, the Fresh and Neef Holding Bhd, and Henniken's, and Hong Kong Industrial Aeon Credit Service, Pusat Malaysia's, and Malaysia Pacific Industry, UNICEF, and the Victros Corporations. So this is the top 10 constitutions which include in the FM70.
Okay. Okay, and then okay. So we have other questions from Mr. Chan here. Okay, hold on, yeah. For how do I know that which is the most active contract month?
Okay, so for the most active contract months, you can see it from, I show you a slide and then you will more understand in how to see which month is have the most liquidity month. Okay, as you can see, you can see the volume here. So as you can see, we have a few months of the contracts, which is different month, and then you can divide it with the most highest volume. So the highest volume actually is the active month for the contracts. For sure, if you are using Phillip Nova, right? Actually, our Nova there, they will show you a active month at this contract, this watch list. So it makes you more convenient to define which is the active month without you go to check which is the what is the volume. For sure, for this one also, for your information, this is extra information for you. Okay.
Okay, let me have a look. So for the next question, okay. So to open account, is it free?
Okay, actually, open account is for in order to open account, if for local products, right, you want to trade like BMD, FCPO, FKLI, actually we will require for 1,000 of the deposits. And then if you wish to go for foreign products, and then you will be required for 5,000 of the initial deposits. But don't worry, the deposit will be reflected in your account once your account is already activated.
Okay, and then thank you for answer. Oh yeah, one more question is that, is the margin same for all the products?
Okay, for the margin, actually different products, we have different margin requirements. So it depends on which product that you are interested, and then you can contact on our representative and then to know more. That's all.
Okay. Donya, okay. Okay. So we have one questions about how about US index futures. I'm not sure about what Mr. Luke asked, but maybe you can briefly explain about the US index.
Okay, so actually for US index, for Phillip Futures, we actually offering four main indexes that which is we have Dow Jones, we have Nasdaq, we have Russell, and S&P 500. So I'm not sure that you want to understand more on the contract specs or more on the fundamental analysis. So if you got interested to know more about the US indices futures, right, you can drop your contacts on you can drop your contact to us, and then we will ask our representative to contact you for you to understand more. Okay, lastly for this month, actually we will started a campaign which is called Jump Traders. So actually it's applicable for those have interested to trade FKLI or FCPO investors. As maybe Yongshen, you can brief more on the campaign.
Okay, sure. Let me Okay, so for this June trade, we just started this month and it will be for 2 months until end of October. So you just open account with us and you will receive cash rewards. By doing that, you also have to start trading. So other than that, you will also receive Foodpanda vouchers. And of course, to receive the cash rewards and Foodpanda vouchers, there is T&C apply. So if you would like to know more about it, you can just directly go to our website, or you can also contact us and we will explain to you more further. Yeah, so I think that is basically all for today. So if you have any other questions, any more questions, do contact us and we are very happy to assist you. And remember to grab the opportunity for our ongoing promotion to join it. And with that, I will also end the session for today. Thank you everyone for your time to join our webinar today. And also many thanks to Miss Jean here for her insightful sharing. So good night everyone and stay safe. Thank you everyone. Thank you for joining this session.